Hello there. Today, this is the first lecture in Chapter 8, Master Budgeting or Budgets. First lecture in Chapter 8, Budgets or Master Budgeting. Learning objective number 1, understand why organizations budget, do the budgets and the processes they use to create the budgets. The word budget, a framework of budgeting, the word budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. Now, we are talking about forecasting. We are talking about predicting for the future. So we will prepare something called budget, and the translation word, which is important maybe here to differentiate between budget and the balance sheet or the financial position. The balance sheet, we prepare our balance sheet for a period in the past. So if we prepare financial position, we say we are preparing financial position for the last year or for the year just finished. But if we say budget, which means we will prepare something like the financial position, but for the next period, which means all the numbers in the budget will be forecasted or expected. In Arabic, the translation for the word budget is muwazani, al-muwazani. The word budget translated into Arabic in al-muwazani, but the financial position or the balance sheet translated into al-mizaniyya al-umumiyya. So al-mizaniyya, something related to the history or the past, but al-muwazani, something related to the future. So our topic in chapter 8 is the budget, which is the future or forecasting for the future. So again, I will read the definition, is a detailed quantitative, we are talking about numbers, plan, which means for the future, for acquiring and using financial and other resources over a specified forthcoming time period. Something will come in the future. A company's budget ordinarily cover a 1 year, most likely. We are covering 1 year period corresponding to its fiscal year. The fiscal year means January 1st, December 31st, most likely in the accounting. And some companies also use a perpetual budget or continuous budget, which is a 12-month budget, but continuously rolls forward. So depending on each other, month by month or quarter by quarter, they are preparing the budget accordingly. Choosing the period 20 to 21, which is the next year, operating budgets ordinarily covers 1 year period corresponding to the fiscal year. Many companies divide their annual budget into 4 quarters in order to give more accurate numbers for the budget. We need to talk about fewer months or less period. So if you forecast or if you predict or estimate numbers for the next month, it will be definitely more accurate than predicting for a year, because at least you can expect or you can see the numbers more clearly for the month. A continuous budget is 12-month budget that rolls forward 1 month or quarter as the current month or quarter is completed. Okay. Budgets are used for 2 key purposes. Why we use the budgets? For planning, and for controlling. Planning involves developing objectives and preparing various budgets to achieve these objectives. So every company will have a goal. This goal will be translated into some objectives, and we are doing our budgets to achieve these objectives. Control involves the steps taken by management to increase the likelihood that the objectives set down while planning are attained and that all parts of the organization are working together toward that goal. So we are controlling our employees, our targets, our atmosphere or the company, and they encourage the whole people to be anticipated, to be engaged in preparing or achieving, preparing the budgets and achieving the goal of the company. Okay. Why do organizations create budgets? From planning perspective, we do have some benefits for the budgets. First, we define our goals and objectives. We think about the plan, think about and plan for the future. So the future is important for us. We are moving forward or think about the future, what will be changed, and if we can compete for the next period, which means we are competing, we are doing a place for our company through our competitors. Means of allocating resources in order to think about the future. We are reallocating or allocating our resources in an efficient way in order to achieve our goals. Uncover potential bottlenecks for any crisis. Coordinate activities. Communicate plans. From planning perspectives, these are the benefits of the budgets. From control perspective, organizations compare their budgets to actual results. So at the end of the day, I will compare between the balance sheet and the balance sheet budget, which is if we achieve these numbers that we expect. So to improve the efficiency and the effectiveness of operations and to evaluate and reward employees. So this for control perspective. How do organizations create budgets? Companies usually create budgets by relying on some combination of top-down budgeting and self-imposed budgeting. Top-down budgeting means the budget will come from the top management and the employees will apply it without any changes. A self-imposed budget, or what we call it participative budget, is a budget that is prepared with the full cooperation and participation of managers at all levels. So all managers or seniors will participate in this budget, and definitely it is better. Why? Because they know exactly more details than the top management for the details needed for the budget, and then they can or up when managers throughout the organization work collaboratively to prepare a budget, then often strive to establish challenging targets that are also highly achievable. Achievable, why? Because the people who put the goals or the objectives for this budget are directly treated with the numbers needed for this budget. That's why it will be achievable from these supervisors. Those goals are likely to build a lower level manager's confidence and commitments to the budget, definitely. Advantages for the self-imposed budgets. It shows respect for their opinions or seniors or employees when lower level managers are involved in the budgeting process. And by the way, the word lower level managers means the people who deal with the workers, with the all hierarchy, let's say the employees in the bottom of the hierarchy. So it shows respect for all people actually engaged in preparing the budget. Budget estimates more accurate than estimates prepared by the top managers, definitely, because they know the details more than the top management. They know the numbers more than the top management, and then all inputs for the budget are from these numbers. Motivation is generally higher, definitely, because also when individual participate in setting their own goals than when the goals are imposed from above, which means they will um, um, do their job harder to achieve their goals. They have a challenge because they set their objectives and they are accountable for that. It empowers them to take the ownership of the budget and to be accountable for deviations from the budget. Self-imposed budgets should be reviewed by higher levels of management to prevent something called budgetary slack. We will discuss this word later. Most companies issue broad guidelines in terms of overall profits or sales. Lower level managers are directed to prepare budgets that meet those targets. The master budget, an overview. These are the budgets that we have to prepare, starting from sales budget, then the production budget. Uh, After the production budget, we will prepare direct material budget, direct labor budget, manufacturing overhead budget. And look at the arrows, means but production budget depends on sales budget. Direct material, labor, and manufacturing overhead budgets depend on the production budget. All of these production, sales, which includes the collection, material, labor, manufacturing, are summarized in a way in the cash budget. So we will consider the cash budget one of the most important budget because it includes the collections and disbursements, collections from customers, disbursements for many things, for the suppliers of materials, for the labor, for the manufacturing overhead. After that, or the end Okay. To help you see the big picture, keep in mind that the 10 schedules in the master budget are designed to answer the 10 questions shown on the next screen. First, how much sales revenue will be earned? This will be an answer for the sales budget. Look at here. The sales budget here, at the end of the, or after preparing the sales budget, we do have to say, or what is the question that we have for the sales budget? Simply, what is the total sales that we will earn in the future? So, how much sales revenue we will earn in the future. Okay, depending on the sales budget, assuming that our sales on credit, then we have to collect from our customers. So we do have a budget called cash collection budget, or sometimes you call it cash collection schedule, which is related to the sales budget. How much cash will be collected from our customer? Okay. For the production budgets, the answer or the question can be drawn for the production budget. What is the total units needed to be produced? And depending on that, we have to prepare the materials, labor, and manufacturing overhead. So if we ask what is the question for the materials, how much raw materials we need to produce or to purchase. For the manufacturing, how much manufacturing costs will be incurred, which is labor and the manufacturing overhead. And it is better to be in two separate questions. So for the labor, what is the cost? What is the total cost of the manufacturing labor we need to produce? And what is the total cost for the manufacturing overhead? How much cash will be paid to our suppliers and our direct laborers, and how much cash will be paid for manufacturing overhead resources? So this is called cash disbursements budget or cash payments budget. What is the total cost that will be transferred from finished goods inventory to cost of goods sold? Remember, if we finalize the production, the finished goods or the work in process will be called finished goods. If we finalize with the work in process, this will be called the finished goods, and it will remain in the company as an inventory. And after that, it will be sold. If we sell the finished goods, then it will be called cost of goods sold. Okay. Next, how much selling and administrative expenses we will incur, and how much cash will we pay related to these expenses, which means we do have a selling and administrative expenses budget, and we have to pay for that. Next, how much money will be borrowed from or repay to lenders, including interest. If we need finance, then we have to include in the cash budget something related to loans and the interest related to this. How much operating income we will earn, which refers to the income here, income budgeted income statement, how much income we will earn, and what will our balance sheet look like at the end of the budget period. And this is related to the balance sheet budgeted. Okay. An overview for the master budget. A master budget is based on various estimates and assumptions. For example, The sales budget, which is the first one, requires 3 estimates or assumptions as follows. What are the budgeted unit sales? How many units do we need to sell or we are expecting to sell in units? And the price for 1 unit, what is the budgeted selling price per unit? And it is related with the sales budget, what percentage of accounts receivable will be collected in the current and subsequent periods. And this is related to, as we say, cash collection schedule or budget. This is an example for the assumption for the sales budget. When we use Excel to create master budget, these types of assumptions can be depicted in a budget assumptions tab, thereby enabling Excel-based budgets to answer what-if questions. Okay, for learning objective 2, which is the practical part for the chapter, we will prepare the sales budget, or we will start with the preparation for the budgets, including schedule of expected cash collections. So let's start with the sales budget, and this is the first point, the key for your assumptions in the future. Budgeting example. Royal Company is preparing budgets for the quarter ending June 30. Remember that we have 4 quarters for the year, and each quarter will have 3 months. Okay. Budgeted sales for the next 5 months are April, May, June, July, August. We are expecting to sell 20,000 units in April, 50,000 units in May, 30,000 units in June, 25,000 units in July, 15,000 units in August. These numbers are, remember that it is expectations or budgeted or forecasting. So these are not actual. We're preparing something called budget, which means we are expecting for the future. And we are expecting the selling price to be $10 per unit. So we forecast our price to be 10. This will be set by studying the situation, the market, the competitors, the status or the financial situation of the people who are living in that place. So the price sets or can be assigned after studying many factors. Mainly we're talking about competitors, but also other factors are important. So assume that we have these units to be sold for the future, and the price is 10. The sales budget simply it includes units multiplied by price only. The individual months of April, May, and June are summed to obtain the total budgeted sales in units and dollars for the quarter ended June 30. For any budget, we need to have a title for each month. If we have a quarter, we do have April, May, June, and the total of the quarter. The sales budget, as I say, it includes budgeted sales in units. We are expecting to sell these units for the next quarter. We are expecting to sell 20,000 units in April, 50,000 units in May, 30,000 units in June. So then the total, we are expecting to sell 100,000 units for the next quarter. The selling price per unit, $10. So we are expecting a total budgeted sales in April for 200,000, which comes from 20,000 times $10. So $200,000 we are expecting to have as a sales revenue in April. 50 multiplied by 10, $500,000 in May, $30,000 multiplied by 10, $300,000 expected sales revenue in June. So the quarter total, 100,000 multiplied by 10, $1 million. We are expecting to have sales revenue for the quarter. That's all for the sales budget. It is simply the units multiplied by how many? The units multiplied by the price. Units multiplied by the price. Okay. Units multiplied by the price only. So the total will be the total sales revenue expected to be for the quarter. Okay. Expected cash collections. Expected cash collections. This is also important, and it is related to the sales budget. Look, the word cash collection, remember that we are collecting from our customers. Why? Because we sell our products on credit or on account. So assume that all sales are on account, and the company, Royals, collection pattern is 70% to be collected in the month of sale. So each company will have a collection pattern, which means a style to deal with its customers. We need 70% of the deal, let's say, in the same month of the sale, 30% to be collected in the month following the sale. This is can be different in different companies. Some companies looking for 50, 30, 20. Some look for 50 and 10s for the following months. So it depends on the company. Okay. 70 for our company, 70% from sales on account to be collected in the same month of sale. Okay. 30% to be collected in the month after the sale or following the sale, which is the next month after the sale. Okay. In April, the March 31st accounts receivable balance of $30,000 will be collected in full in April. Look, if we're collecting 70-30 and we are collecting 70 in the same month, 30 in the following month. So if we are thinking about the last month for our quarter will be March, is it? Last month for our quarter will be March. And we collected already in March 70% of the sales of March in March. And the 30% will be collected in the following month, which is April. So we are collecting in April 30%, which represent 30,000 of sales, March sales. So for the expected cash collections schedule or budget, cash collections budget, we start with the collection in April. If we have anything in the past to be collected in the April, we will start with this. So we will say we will collect 30% of March in April according to our pattern collection. So accounts receivable March 31st will be 30,000 given the question. And then we will say the sales of April will be collected according to 70-30. How do you know what is the total sales of April? We will go back to the sales budget. So we are waiting for collection of 200,000 related to April. This number, $200,000, will be collected 70% in the month of sale, which is April, 30% in the month following the sale, which is May. Okay, so look, we are expecting for April sales, which is $200,000, This comes from sales budget. Okay. For April, we are expecting to collect 70% of 200,000, which equals to 140,000 to be collected in April. Okay. And 30%, which is 30% times 200,000, which is 60,000, this will be collected in May, which is following the month of the sale. Okay. For May sales, we do have 500,000. Similarly, the 500,000 will be collected 70% in the same month, which is May. 70% of 500,000 equals 350,000. This will be collected in May, which is the same month of sale, and 30% to be collected in the following month, which is June. 30% times 500,000 equals 150,000. So we are waiting to collect 150,000 for May sales in June. Okay. Now, for June, which is 300,000 from sales budget. Look, we will collect 70% of 30 or 300,000, which is 210,000 in June, and postpone the 30% collected in the month following the sale, which comes in when? Which comes in July, which is outside of our budget. So I will not include the 30% of June sales in this budget. Why? Because will be collected in July, exactly like we collect the April, the March 30,000. Okay. So look at the collections in June. For June sales, we will collect 70% of 300,000. So we will collect 210,000, and we will not include the 30%. Why? Because it is collected in July, which is outside of our quarter. Okay. That's why we do have a quiz here. What will be the total cash collection for the quarter? The trick is only to exclude the 30% of June. Then we need to add the numbers for the quarter. We do have 940,000, which is 30 plus 140 plus 60 plus 350 plus 150 plus 210. Or if you like, some of April 170,000. We need the sums, by the way. We need the totals of the months in addition to the quarter. So the total expected cash collections in April will be 170,000, which is 30 plus 140. For May, 410,000. For June, 360,000. These three numbers will equals to 940,000. If I ask a question now, what is the accounts receivable at the end of this quarter? What is the accounts receivable at the end of this quarter? It will be the 30% postponed, the 30% related to June postponed for the next month, which is 30% times 300,000, which is the sales of June, equals 90,000. So the accounts receivable balance at the end of this quarter is 90,000. This was all about expected cash collections. Expected cash collections. Okay. The next important budget, which is the production budget. Production budget. Learning objective number 3 of prepare the production budget, one of the most important budgets, because this is also a key for the following budgets. It will be a key for materials, labor, and manufacturing overhead. And it affects the following budgets. The sales budget and expected cash collections budget. When we complete it, then we will prepare the production budget. The production budget must be adequate to meet budgeted sales and to provide for the desired ending inventory. This means that the base for the production budget will be the sales budget. Why? Because if you need to sell, according to our example, go back to the sales budget here. We say we need to sell 100,000 units for the quarter. 100,000 units for the quarter. Then the following question is, do you have this production, or how many units do you need to produce in order to meet these expected sales? First. Second, we will depend on the budgeted sales in units, not in dollars. Why? Because the production deals with the units. If I need to sell 100,000 units, then this means that I need to produce 100,000 units plus. Okay. Again, the production budget depends on sales budget, and it depends on the first line for the sales budget. The question is, if I need to sell 100,000 units for this quarter, so I need at least 100,000 units to be produced in order to meet these sales. 20 plus 50 plus 30, which means 100,000 for the quarter. I need to produce at least 100,000. So we will depend on these numbers first. So the first line for the production budget will be the first line for the budgeted sales in units. So 20, 50, 30, keep this in your mind. Production budget, look, budgeted sales, 20, 50, 30. So the first line for the production budget is the first line for the sales budget, which is also expected by the company. Okay, the production budget part 2. The management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. The point is, why do we need the ending inventory? Suppose that I'm talking about April. If I need to sell 20,000 units in April, which is here in the sales budget, I need to sell 20,000 units in April. Do I need to produce only 20,000 units? This is the point. So the company needs for any unexpected demand, or any changes happened in the future, to have some units in the warehouse. Assume that we do have an occasion, any festival, or something unexpected, let's say, to exceed the 20,000 units. So at least we need 20,000 units, but for planning, any unexpected events may happen in the future. So the company are interested in to keep in the warehouse a 20% of the next month's sales expected. Okay, so go back to the production budget and read this word again. The management at Royal Company wants the ending inventory to be equal to 20% of the following month's budgeted sales in units. So at least we need that number of units, but we need to keep also 20% of the following expected sales in units. On March 31st, 4,000 units were in our warehouse or on hand. 4,000 units were on hand, which means we do have in our warehouse at the beginning of the quarter, which is March 31st. This means April 1st, beginning of the quarter, we do have 4,000 units on hand, means in our warehouse. Let's prepare the production budget. If Royal was a merchandiser company, it would prepare a merchandise purchase budget instead of the production budget. Definitely, we don't have a production, we do have a purchase, which means beginning plus purchase minus ending. Okay, for the production budget, as I say, we will start with the production, with the budgeted sales. Budgeted sales, and this comes from sales budget, right? 20, 50, 30, total for the quarter is 100,000. We will add desired ending inventory, According to the question, we will have 20% of the following here, following months budgeted sales in units, which means for April, we need 20% of May sales in units. Look, for May, we need desired ending inventory to be 20% of May sales in units, which means 50,000 multiplied by 20%. This equals to 10,000 units. Then we need additional 10,000 units to be in our warehouse for any unexpected demand. Okay. So we need in total, the desired ending inventory will be added to the budget that says we need in total 30,000. Okay, total needs 30,000, but we have already in our warehouse from last period 4,000 units. According to the question, look, we have on March 31st 4,000 units were at hand, which means beginning inventory for our warehouse, for our period, beginning inventory for our period. We do have 4,000 in our warehouse as a beginning inventory. So we will deduct the beginning inventory because we have already 4,000. So we will deduct it from the 30,000, and the answer will be the required production for April, 30,000 minus 4, and the answer will be 26,000. 26,000 to be produced for April. Okay. What about May? What about May? May, we need 50,000 units budgeted sales, and we will add desired ending inventory 20% of June units, which is 20% times 30,000. This equals to 6,000. So the desired ending inventory will be 6,000. The total needed will be 56,000. 56,000. Again, the 6,000 calculated by 30,000 June sales times 20% given in the question. So 56,000 minus what? Beginning inventory of May. Beginning inventory of May. This will be the ending inventory of the last month, which is April. So the 10,000 units ending inventory of April will be beginning inventory of May, right? So the 10,000 will be deducted from 56,000, and the answer will be 46,000. Okay. What about June? We need 30,000 units to be produced for June, depending on the budgeted sales of June at least. But we need 20%. as a desired ending inventory from the following month, 20% of the following month sales in units. Following month of June will be July, but we don't have July in our budget, but we have it at the beginning of the sales budget example. Look, go back for the sales budget and read the information related to the question again. We do have 25,000 units budgeted sales for July, budgeted sales of July, 25,000 units. And then we will use this for the production budget for June. Why? Because we need to say 20% times 25,000 budgeted sales of June. This equals to 5,000, right? So total needs for June, we need 35,000 units, 35,000 units. Minus the beginning inventory of June. Beginning inventory of June will be the ending inventory of May. So the 6,000 here will be from the ending inventory of May. So 35,000 minus 6,000, this equals to 29,000. Okay. 29,000. Now the totals, the first line is easy. 20 plus 50 plus 30, which equals to 100,000. The second line is important. Look, desired ending inventory. The 5,000 represent what? The 5,000 represent the ending inventory for the quarter. Ending inventory for the whole quarter, which means the ending inventory of June only, right? So for the quarter, the ending inventory will be only 5,000, which represent the last ending inventory that we have for the quarter, which is the ending inventory of June. Okay. So the total needs 100 plus 5,000. This equals to 105,000. Similarly, the beginning inventory for the quarter will be the beginning inventory for the first month, or at the beginning of the quarter, we do have only 4,000. This represents the beginning inventory for the quarter and the beginning inventory for the first month. So the number will be only 4,000. So 105 minus 4,000, this equals to 101,000 units required production for the whole quarter. Okay. Let's stop here for today. The beginning of learning objective 4, prepare the direct material budget. Also important, including the schedule of expected cash disbursements for the purchase of materials. Let's stop at the end of the budget, production budget. Thank you.